So I'm very happy to be here today to have an armchair chat with Conor Donaldson. His biography, I believe, is in your materials, but Conor's been with the IAS for over a decade and also in the financial services industry in Canada prior. So Conor, the first question, protection gap has been a key focus of insurance supervisors for many years. Last year, it was a key focus of the NAIC under our theme, Minding the Protection Gap. The IAAS established a Protection Gaps Task Force to generate best practices among insurance supervisors globally. Can you unpack the IAAS work and tell us where it's going?
Perfect. The microphone's working, right?
Yes.
Okay. I have a loud voice in any event, so it's a Canadian thing. We're used to having to yell across long distances to reach our neighbors. There's a lot to unpack, actually, because I think for the IIS, it really was a progression to get to where we are in terms of prioritizing the work that we're doing in the area of protection gaps. So in 2023, we published a paper, which was our call to action, which was really focused in on what is the role that supervisors can play in that multi-stakeholder effort that's necessary to actually close, reduce, narrow, whatever adjective you want to use, the protection gaps that we're facing. And I think all of us recognize that protection gaps are significant. So this paper in 2023 really did get a very significant reception amongst our broader stakeholder community. I think that people recognize that the IIS had come a long way as an association to look at an area that wasn't necessarily core within the mandate of insurance supervisors. It was recognizing that insurance supervisors have a role to play in something that is cross-sectoral in nature. It involves policymakers, it involves other regulators, it involves the industry. So it was, I think, for the IIS, one of the first times that we really took a stand in saying that insurance supervisors have a voice, and it's a critical voice if we're going to actually make progress in reducing protection gaps. So then in 2024, as we were developing our new strategic plan to guide us over the course of 2025 to 29, we really did recognize that protection gaps were going to be an important focus for us as an association. So we, of course, are a standard-setting body at our core, but we also recognize that there's areas of activity for the IIS, and we articulate our strategic themes that are going to guide us in terms of how we look at our core objectives as a standard-setting body. And one of the strategic themes that we identified was, what is the role of the IIS in supporting insurance to serve its purpose of building resilience? And this is something that I think was a reflection of the work that we had done in 2023. It had really driven the thinking to actually build the strategic theme that's going to guide us in terms of how we look at our standard-setting mandate, how we look at our work on the financial stability space, how we look at our work in building capacity for supervisors, and as well the assessment program that we run. So here we really did build this into us. It's a foundational part of how we're going to approach the next 5 years. So we have our call for action paper. We followed that up in 2024 with a paper for the G7 presidency that was looking at private public insurance programs, so the collaboration that's important there. We have work right now, and I'll have an opportunity to mention it a little bit later, as a contribution paper that we've been doing with our friends at the World Bank for the G20 Sustainable Finance Working Group. And as well, we've been doing a number of other activities, application papers, issues papers, looking at aspects of societal resilience and how supervisors can contribute to actually addressing some of the drivers, causes, but also hopefully supporting some of the ways, the opportunities that the sector can play in terms of addressing protection gaps.
Great, thanks so much. We're seeing the larger financial services sector put a greater focus on closing protection gaps. At last year's IMF annual meetings, Commissioner Mays joined an inaugural panel on resiliency and protection gaps, which the IAAS was also a part of. So this is growing larger than just the insurance industry. In your opinion, what has changed and why is it so top of mind now?
Yeah, I think the growing focus on protection gaps is really a recognition of the fact that there's a number of drivers that are contributing to the growth of protection gaps. And so we've been really focused on the nat cat protection gap. And so we look at the ways in which climate-related disasters are increasing in severity and intensity and frequency. And some of the trends that we've seen in terms of urbanization, frankly, the costs of recovering and rebuilding post-disaster. So these are increasing protection gaps. But we also look at the fact that because of this increasing frequency and severity, this does put stress on the broader financial system. I made a joke earlier about being Canadian, but I'm from a very beautiful part of the world. I'm from Vancouver. It's a lovely place. It's surrounded by mountains. There's forests everywhere. But unfortunately, what we've seen over the last few decades is actually we've gone from a place where there's 4 beautiful seasons to one where there's 3. And these 3 are freezing, flooding, and fires. And over time, you can imagine that the stress that places on communities, and particularly some of our rural communities that are really essential for the economic growth and development of the province, are really put under stress. We've seen entire communities wiped off the map due to forest fires. And I know, looking around the room, I have friends from other places in the world where they're facing these similar challenges. And so there's no way that we can say that this isn't going to have an impact on the broader economy and the broader financial system. So I think it's really important that we recognize that, unfortunately, protection gaps are becoming more significant. The drivers of protection gaps are becoming more apparent. And unfortunately, if we're going to actually address some of the drivers, it really is going to require that we work collaboratively across the financial sector, but also working with policymakers, working with other stakeholders that are involved, because this is fundamentally going to affect the quality and nature of the lives that we live.
So the G20 is working on protection gaps and resiliency issues as well. Could you tell us about the G20 efforts and how the IAAS is contributing to them?
Yeah, so I mentioned this in my opening. So we were asked by the South African G20 presidency to develop a paper looking at protection gaps. And this was really building off the work that we had done with our call to action paper, and as well the work that we had done under the G7 presidency, the Italian G7 presidency. And in this paper, it was really designed to be a furthering of thinking around what can we be doing across the sector to actually drive tangible progress in reducing and narrowing protection gaps. And because, of course, South Africa is an emerging market, they really were keen on seeing us take a strong emerging market focus. So we partnered with the World Bank. My friend Danita sitting over there. We've worked very closely with the World Bank Group in driving this paper forward. And I think ultimately, in a short period of time, I think as an association, and I think this feeling is shared by colleagues at the World Bank, we're quite proud of what we've been able to accomplish. It's a paper that's really, I hope, going to generate some further thinking and raise awareness at the level of finance ministers and central bank governors around the significance of protection gaps and what is necessary if we're actually going to see progress in this area. But I think also this focus on emerging markets. And emerging markets face unique challenges when it comes to protection gaps. Oftentimes what we see is that the insurance sector is not that well developed. Secondly, what we see is that there's been a lot of economic development and growth, but often people are standing one disaster away from sliding back into poverty. And this really does create an incentive if we're going to see sustainable economic development. It really does create an incentive for us to see the insurance sector grow and its ability to address some of these challenges increase. And so I'm very happy this collaboration with the World Bank. It's been something that's really driven that focus on EMDEs. And this paper hopefully will be a solid contribution. As a next step, what we're trying to do is to really work collaboratively with a number of different partners to see how we might be able to build a bit of a toolkit or some sort of capacity building support that will work with supervisors in their engagement with policymakers, with other stakeholders within their respective jurisdictions to be able to actually drive collective action and really that multi-stakeholder action that's necessary to reduce protection gaps. So we've had a number of conversations with the Global Shield, which is an initiative sponsored by the German government, but has drawn in a number of partners from around the world to support resilience around climate-related risks. We've had conversations with the Insurance Development Forum. We have a long collaboration with the World Bank and with the Consultative Group to Assist the Poor, an entity that's hosted by the World Bank, and the Toronto Centre, which has been very active in supporting supervisors and capacity building. So really trying to bring all these partners together to see if we might be able to drive really collaborative actions that are going to be able to support supervisors in understanding and taking actions within their jurisdiction to address protection gaps.
So in your mind, which gaps stand out as the most important to address? We've already addressed Nat Cat and climate, but what about cyber, life, and retirement?
You know, it's interesting. Actually, I think after that last panel, I'm more concerned about longevity.
Me too, by the way.
And retirement, man. Yeah, I think that, for us, we've really prioritized that Nat Cat protection gap. But what we're seeing, of course, is that there's a range of different protection gaps that are, increasing in significance. I was joking with a colleague earlier that, I think, unfortunately, this isn't an age-related joke. But I think many of us are from an era when there was no such thing as cyber-related risk, unless that involved, the punch cards that went into computers disappearing or getting burnt in a fire. Cyber-related risk was not a risk, but now it is, and it's one of the most significant protection gaps that we're facing. I think when we look at some of the ways in which the economy is evolving, we have to be mindful that there is risks that are the unknown unknowns, and those could be on the in the future, some of the most significant protection gaps that we face. But I do think, ultimately, as societies, looking at the ways in which demographics are influencing our economy, looking at ways in which cyber risk is evolving, looking at long-term savings and some of the challenges that we face in terms of people preparing for retirement, and frankly, a scaling back of state support in a number of jurisdictions. These are all very significant protection gaps, and I hope that our call to action paper, whilst focused on Nat Cat protection gaps, really does actually provide a framework. Really does provide a framework in which supervisors can take action, work collaboratively across the different stakeholders within their jurisdictions to actually understand steps that can be taken to really digest, understand, and take action on some of these protection gaps.
So as the IAS will be publishing its mid-year global insurance market report, can you speak a bit about how protection gaps will be factored into the special topic for this year?
So our GMAR is really an analytic piece. So it really does dive deeply into global risks and trends and developments that are facing the insurance sector. And as part of the GMAR exercise, we developed these special topics. And the special topics are driven by items that are coming out of our global monitoring exercise, but they're also potentially representative of other priorities for the association. So our special topic for this year is really looking at the financial stability implications of protection gaps. And so we're looking at how insurance protection gaps could create spillovers, other parts of the financial system and the real economy. And we're using a range of different case studies to explore transmission channels and consider both financial and human impacts. Now, this is a complex undertaking because there isn't that much literature out there, both in terms of the research at the academic level, but also in terms of some of the more policy-oriented research that's looking at some of those financial stability implications from protection gaps. But what we are seeing, I think, is an increasing awareness at the more micro level around how some areas of the economy are directly affected by disasters and increasing risks, such as climate-related risks in jurisdictions like California. It is affecting mortgage. It is affecting credit. And so there is, at the micro level, I think, an increasing body of knowledge around the implications that Nat Cats play in terms of the broader financial system. And I think as a result, it's only a matter of time but it is going to be, I hope, an important contribution that the IIS is making towards building that better understanding of the ways in which protection gaps impact financial stability.
So what do you see as the future for protection gaps? Will gaps get smaller or larger? Will we see gaps developing in new areas?
I don't want to be a pessimist. But frankly, the future of protection gaps is largely going to depend on how we address the underlying drivers. And frankly, I don't know about you guys, but I don't have a lot of hope at the moment. Because what we're seeing is actually a continuation of a lot of the trends that have been driving protection gaps. Whilst I think increased awareness will hopefully drive behavioral shifts at the individual level, at the society level, at the regional and national level, it is something that I think all of us are aware of, that the trends that have made protection gaps increase so rapidly and the scale to increase so quickly is unfortunately still there. That said, we are, I hope, beginning to see that understanding and awareness. And I think the number one thing that we can do in terms of reducing protection gaps, it's reducing risk. And there is an awareness that's growing around the steps that we can be taking to reduce risk. And I think there's a number of very positive examples that we see. We've been trying to capture some of these as case studies around steps that supervisors, insurance sector, other levels of government have been taking to reduce risk or to increase protection. And I think these are great case studies, but we haven't seen that, I would say, that significant shift that's going to allow us to take that step back and say that we actually are seeing a reduction in protection gaps at that aggregate macro level. They continue to grow, and the size continues to increase.
So how are regulators and supervisors expected to respond?
Our call to action paper really did identify 5 specific areas that we think that supervisors can play a role. And one is, of course, in assessing insurance protection gaps. So building that understanding and awareness, collecting data, promoting the development of models, of tools to assess and understand protection gaps within your jurisdiction. Secondly was on this question of consumer and financial literacy. No, absolutely, and I think we heard this, and it's been almost a feature of every discussion that we have around insurance, is that people really need to understand the risks that they face. And optimism bias is unfortunately a big challenge, but people really do need to embed that thinking around how do I prepare for bad things that are likely going to happen. And so we have to build that understanding. But we also have to build that broader risk awareness. And that's not just at the individual level, it's at the family level, it's at the business level, and it's at the community level. And so building risk awareness and understanding around the risks that you're facing, the significance of them, what are some of the steps that we can be taking, this is very important. Looking at the understanding of the risks, then it's about really how do we incentivize or encourage steps to reduce risk or to take other mitigation or adaptation steps. These are very important. If we're going to actually reduce risk, we have to be prepared to actually invest in mitigation, adaptation, and prevention. For supervisors, and this is something that for a lot of us, this is in our control. We have the levers to be able to do this. It really does require a thoughtful approach, but we have to build the enabling environment that encourages the insurance sector to address the risks that contribute to or provide the solutions or the risk transfer tools to individuals, families, businesses, and communities to be able to grow in their role within the equation. And so we've been looking at this from the perspective of both the micro level, so how do we encourage greater uptake of insurance, increase or deepen insurance penetration in markets, building more inclusive insurance markets, and particularly important in emerging markets, but frankly, I think all communities, all countries have vulnerable and underserved segments of the population where access to insurance is limited, and these people really do need to have the tools to allow them to manage their risks, and supervisors can play a role in encouraging the insurance sector to meet that need. But we also can look at it at the macro level or at the community level, thinking about innovations that could potentially address some of the unique aspects of NatCap protection, some of the NatCap protection gaps, but looking at parametric type tools, index-based tools that can provide part of the solution in terms of that risk transfer that's necessary and hopefully contribute to recovery and rebuilding in the event of a NatCat. And then lastly, the insurance supervisory community, and this, for me, is really become core to how we need to think about the role that we play. And that is, we have a strong voice and an important voice, and we need to play a more assertive role in supporting governments to work through some of these challenges. And so the advice that we can provide to government, to policymakers, to legislators around what steps could be taken to address NatCap protection gaps or other protection gaps, this is really important. And so we can advise on the design of tools. Absolutely. We've seen examples. My friends from Morocco who are in the room, they played a critical role in developing a tool that's really actually come a long way in supporting or addressing the protection gap associated with earthquakes. This is very important that the regulator play a critical role. We have a strong voice. We have an important voice. And we really, I think, are, I hope, coming to a point where there's a lot more confidence to be able to use it, because I think that we can play a critical role in how we reduce or narrow protection gaps.
So I think we have just enough time for one of the Slido's questions. So let me ask.
Oh, I didn't even know there were Slido questions.
Yeah, there's Slido questions. There's a couple of them.
Uh-oh.
So this one, the first one, is the emerging market panelists spoke about larger jurisdictions learning from emerging market trends. What can the U.S. learn on protection gaps from these trends? It's a real easy question.
Yeah, cool. Yeah, thanks very much for the question. What is that saying? Necessity is the mother of all invention. And I think what you see in a number of emerging markets is that developments and trends are taking place faster than maybe some of the underlying infrastructure or some of the broader sort of public sector architecture is developing. And so to be able to actually address some of the risks and challenges that people are facing, they have to look to new tools, new distribution models, new ways of collecting and analyzing data because there isn't that infrastructure there. So there is actually, I think, a lot of developments that are taking place in emerging markets that are very instructive. How do you address situations where you have imperfect data? How do you address situations where distribution channels or traditional distribution channels don't work? Well, this can be very instructive, particularly in markets. No offense to anybody who works in the distribution space here, but distribution adds a lot of costs. And so when you're trying to serve underserved segments of the population or poor and vulnerable consumers, actually getting control of some of those costs that are embedded within the insurance life cycle, this is really important. And so I think a number of emerging markets have demonstrated that there's different ways that we can address challenges like this. So I think it is important that we give them a strong voice because there is a lot to learn. And as I said, necessity is the mother of all invention.